So, and you made an interesting observation about the global financial crisis in this regard, which is, again, there were ulterior motives as opposed to the profit motive. So, for example, the politicians wanted to make housing and home ownership affordable. And so you said that, I think, a market that was historically very, very safe had something like a 1%
That's right.
loss ratio suddenly went through the roof because there were other motives guiding the banks. And that made me think that, well,
Is that the first time you had heard that explanation?
Yeah, I guess explicitly, because what people tend to do is they tend to look at techniques. So like they blame things like mark to market, and they say, well, Enron did it first.
But that did have a role.
It did, but I actually think your analysis comes first, because I think what happens is you have the wrong metric, you have the wrong incentive, and that creates bad governance.
Now, the mark-to-market, I was actually thinking of in different terms. The mark-to-market is what happened when the markets disappeared, and then the regulators used mark-to-market to basically wipe out the capital. Morgan Stanley had to declare $8 billion of losses in one quarter because it had these assets which were probably going to end up being worth at least 90 cents on the dollar, were being marked at 15 cents. And that accounting gesture alone just wiped $100 billion out of bank balance sheets. So in that sense, it was a purely accounting artifact that required the banks to raise capital instantly.
In the middle of a crisis.
Yes.
I was thinking about the other side of that coin, which is the way Enron books profits.
Okay. I don't think that played a major role in the bank crisis. I mean, what I see is first of all, I think the public sector, really deserves the dominant responsibility. They are the without which nothing of the global financial crisis, in the sense that they basically encouraged the creation of something like $4.6 trillion of substandard mortgages. I think they were Alt A's and subprime. And the way these mortgages worked is that you could, under customary mortgage underwriting, to buy a house, you have to put down 10 or 20% of the purchase price. And that's a rule that Canada has continuously maintained throughout. And Canada did not lose a bank, did not suffer at all during the global financial crisis. Nor has it, America has had 12 major banking crises in its history. Canada's had 0. There have been restrictions in interstate banking in America ever since Andrew Jackson came in, which meant that we had 50,000 banks in America because every politician wanted to have a bank in his hometown. So when there is a weakness in the economy, the whole system collapses because the links are so weak that all the small banks begin to disappear. And Charlie Calomiris has a beautiful book called Fragile by Design, The Origin of Bank Crises and Scarce Bank Credit. And he just makes that comparison. There's a good reason America's had 12 major banking crises. And it's built into the political design of the banks themselves and the political clout of every state legislator to have his own bank. And that system was not abolished until 1990, the prohibition on interstate banking. Whereas Canada has 5 large banks, and cross-provincial. This was built into Hamilton's banking system. Never had a banking crisis in 200 years, which people don't understand. And so I would argue, and Calomiris argues in his book that the main cause of the global financial crisis was these $4.6 trillion of bad mortgages, which were originated by American banks. And then they were sent around the world to Deutsche Bank, all these European banks, Japanese banks, loaded up on these, they call them crap assets. You read Michael Lewis's book, The Big Short. And then the other major contributor was bank capital requirements that were on the order of 3% of assets, which is a ridiculously low number. So it was almost, Charlie Calomiris interprets this as a game of bank bargains. In other words, the implicit bargain was, if you make bad mortgages, we will allow you to operate with 3% equity. And you put those two factors together, and you created basically a $500 billion hole in bank balance sheets. And that's the amount of money that the U.S. government ended up pouring into the system. They tried buying up assets in the TARP program. That was a failure. So then they said, let's put equity capital into all these banks. And that was the key. They basically put the $500 billion back. That restored confidence in the system so that banks would now begin buying each other's paper, and they gradually got things back on track. But the U.S., in my view, created the global crisis. It was U.S. policy. It transported it to every country in the world. Every country in the world that was buying these bad mortgages, which ended up having losses of over 10%. We still don't know what the losses were on these bad mortgages, but you multiply 10% times 4.6 trillion, you get a number close to 500 billion. And that's the number they ended up, as I said, pumping back in to support the system.
But I still think the root of the problem is similar, and it runs right the way through your book, which is political interference in the free market.
Right.
And then the reason that the global financial crisis is so difficult to diagnose is that following that, there was all sorts of strange behavior, because as soon as you mess with the free market, people respond and adapt in many ways. So, for example, okay, you had all of these terrible loans, but the European banks didn't have to buy them, but they found ways to buy them. So the inadequate capital requirements, the pie in the sky modeling, from interference in free markets comes a kind of a manipulation of how you see the world in order to just make
everybody
it
was
right
paid
somehow.
to distort. The credit rating agencies all, they had never seen mortgages with 10% losses. So no quant could look out in his crystal ball and say, ooh, we're going to have 10% losses on these things. They say at most we'll have maybe, if 1% is the historical average, maybe we'll have 2% losses. I'm going to go out on a limb here. No quant could ever, and so they're accused of being, mercenary, compliers with, but they're not. They were being honest. They used their historical techniques, and everybody was paid to promote this system. The mortgage underwriters were, Fannie Mae and Freddie Mac were not only encouraged by Congress, they were required by Congress to do these bad loans. So rich people would take out mortgages of 2% on a multi-million-dollar house, and if the house price went down by 40%, rich people walked away from these mortgages en masse. And that's how we got to in excess of 10% losses.